everyone. I'm now joined by Eric McArdle. He's the managing director of the advisor solutions at Simplify. Eric, can you kind of talk to us a little bit about what Simplify does, what it hopes to achieve as a company, and why we should be putting our hard-earned dollars into your guys' funds?
Sure thing, and thanks, Cody, for having me. I really appreciate it. I'm glad to be here. So Simplify was founded back in 2020 by a team of industry veterans from across the ETFs and the asset management space. And really, we came to market following two rule changes. One made active ETFs easier to launch. The second made the inclusion of derivatives within the ETF wrapper much more open-ended, right? You could basically take hedge fund-like derivative exposure, higher vol, higher concentration derivative exposure, and include it in an ETF. And it really just opened the door for somebody to come in and really kind of take this new opportunity and use it as a blank canvas, right? And so the way that I describe our business is we try and bring hard to reach stuff to the everyday person, right? Whether that's a financial advisor, whether it's a retail investor, an individual investor, or whether it's an institution, right? And we want to give them the tools that were available exclusively to Wall Street, right? And do so in a packaged product that is low cost, liquid, and transparent. And so that's kind of what we're here to do. And I think over the last almost 4 years now, we've had a good time doing it. We've learned a lot, and we've worked with a ton of clients along the way. So we're very grateful and very excited to be doing what we're doing right now.
Right, and as you said, this is kind of a strategy that a lot of people on Wall Street already practice, but this is a way to kind of expand it to the masses. So I think the main ETF everyone wants to talk about is SVOL. I know it's not super easy to kind of understand their strategy. Could you maybe kind of high level talk about how SVOL works?
Yeah, absolutely. And SVOL is actually my favorite fund of ours, which is, it's kind of like picking favorite grandchildren, not children, because we have, 27 products now. So that's saying something, right? But it's a really interesting strategy. It's really designed, the name Simplify Volatility Premium ETF. It is kind of a technical way of basically saying that we are, selling effectively insurance on the market, right? So we are trying to harvest a natural market structure, a natural premium that is generated in the market over time by either people trying to hedge their equity exposure or speculate by being long volatility or long movement in the S&P 500. And so, really, if you think about that type of exposure, and I'm going to go into some charts here in a sec just to give people a visual and a resource that they can use at home. But being short vol is something that most investors are all the time, right? And they don't really think about it that way. But when you're long stocks, when you're long risk assets, you are short volatility, right? And so within SVOL, we're looking for what we view as the best reward to risk for being short volatility, using things like VIX futures, but also going into the fixed income volatility market and to diversify that exposure and have a consistent income stream that pays out to investors based on our risk taking, right? And so being short VIX or being short VIX futures, to be precise, is very similar to being short a put on the S&P 500. Similar correlation to those two profiles, similar outcomes during different environments, right? Whether the market is going up, right, you would expect to see your short VIX position do well, just like you would a short equity put. And then same thing on the opposite end, right? As if equities fall and VIX goes up, right, and you're short the VIX or you're short a put on the S&P, that is generally going to be where you would experience a little bit of downside. So if it's okay with you, Cody, I'd like to just share my screen here to give people a little bit of insight on what we're doing. This is a website that you all can follow at home. It's called VIXCentral.com. It's all, VIXCentral, one word.com. We're not affiliated with this, but I just happened to come across it at some point, and it's a lot cheaper than access to a Bloomberg terminal, right? So when you pull up this website, what you'll notice is that there is a upward sloping curve here, right? And this is a pretty, consistent feature in all risk assets, in that the further in time you move forward, the higher the premium on risk is, right? And so put differently, like if you think about your home insurance, right, or your car insurance, if you were to go buy a 3-month insurance policy, you would expect it to be cheaper than a 12-month insurance policy, right? Because there's more uncertainty in that 12 months. And so the market prices risk very similarly, right, most of the time. And what we do is we sell a VIX futures contract at a point, or multiple contracts at points on the curve. And then we are looking for the best reward to risk, so that, over time, the contracts naturally will drift down, and then we will buy them back and capture that spread. And so different markets look a little different, right? Sometimes this curve will be much steeper. Sometimes it will be flat or inverted. Within SVOL, we manage to that market dynamic and try and make sure that we're, risk-minded when putting together the portfolio for investors.
Right. That's that harvesting volatility aspect of it. So what would you say is kind of the ideal market condition for SVOL to kind of succeed?
Well, when you are harvesting volatility, what you're hoping for is that the market does not realize high volatility. And what that, in different words, realized volatility is what actually happens. Implied volatility is what the market, expects could happen, right? And so, as you notice in this curve, again, because there's more uncertainty the further you go out, you can kind of think of this as being a premium on taking risk, right? And so a perfect scenario for SVOL is a market in which the realized volatility, or what actually happens, stays well below what's expected, right? And so think of that as you selling a contract or opening a contract, whether it's in VIX or whether it's in fixed income options, and then it is letting it naturally decay, kind of like an ice cream cone melting off, right? That is what you want. That's what drives the income in the strategy. That's what keeps the NAV, or the price, fairly stable or slowly accruing over time. On the other hand, if realized volatility starts to become elevated or higher than what you originally expect, that's where you can see some downside pressure in SVOL. And so I'm happy to pull up another chart in a little bit and take a look at different environments for that. But that's effectively what we're doing. And so there's two elements to that. Then there's the starting point of where you open your position, right? And then how VIX, or the curve, more specifically, this curve changes over time. Yeah. As well as VIX level, right? The starting point of VIX.
So just to kind of summarize there, so kind of an ideal market condition would be one where volatility is it's not too high, but on the other side of that, where SVOL might run into some trouble is if there's a lot of uncertainty in the market, lots of increased in volatility. That's where, it wouldn't be ideal for SVOL.
There's kind of this reduction to, thinking about being short vol and just looking at the VIX, right? And so, if you think about an average level of VIX, it's 18 to 20 historically. The temptation is to look at a low level and go, okay, VIX must now, mean revert effectively, right? Kind of get back to that average. And while, there's some truth to that, you can remain in a low vol environment with a very steep curve for a long time. And that can be very profitable as a income generating source, right? So, when you are short this vol exposure, or, short VIX, again, you kind of have to think of it like being, long equities, right? So it's got equity-like exposure, equity-like correlation. But really, I think, what's most important is kind of the second derivative of VIX, or looking at what's called the volatility of VIX, right? And so if you see VIX go from like low level to high level to low level to high level, right? And, now you're thinking, okay, I'm short, different parts of the curve, and this is happening, and I'm short, I'm getting hit, I'm short, I'm getting hit, right? That is a really challenging environment for SVOL. And so, we kind of experienced that at the tail end of 21 into early 22, where vol picks up and becomes much more, unbounded, we'll call it. And that's bumpy ride, right?
Right.
But the VIX levels themselves, coupled with the shape of the curve, making sure that when you're shorting a contract, you're moving down the curve, right, to capture that spread. You can benefit from that in really any type of VIX environment, whether it's low or high.
Okay, so SVOL currently has around a 17% dividend yield, trailing 12-month. It's actually, when I last checked, has actually outperformed the overall S&P 500. So, that's pretty good. How would you say, kind of those distributions that SVOL is giving out every month, how are those generally taxed?
It's a combination of ways that they can be taxed. And, just to put it out there, I can't give tax advice, right? But just as a general guidance, you're thinking about the sources of income or the sources of distribution that are coming out to shareholders. We have a few, right? We have ordinary income, which is the income generated from selling VIX futures or some options on the portfolio, right? So we haven't really talked about the fixed income vol or fixed income piece, but that's a secondary source of return when VIX is kind of lower or suboptimal, right? So that you can expect to come out as ordinary income. Our cash collateral is in treasury bills typically, or some type of investment grade bond, right? So we can have interest paid out to shareholders. And then we can also have occasionally capital gains. Let's say, we haven't spoken of this yet, but the hedge that we're purchasing to protect our portfolio from catastrophic moves in VIX, right? The tail hedge on VIX effectively. If we saw a market where, VIX went from, let's say, 16 where it is today to like 80, right? Kind of like a COVID-like event. Our goal is to monetize those calls or sell them, and then we would eventually pay that out as a capital gain. Now, the last component or the last type of distribution classification could be return of capital, right? And this is something that we started, labeling in the last year, and that is a function of us trying to smooth out the income through different periods. That could be a feature, or could just be a tax treatment from the sub-account of the fund. And so, again, we've had a lot of questions about that in the last year, I think rightfully so. But effectively, the arbiter of, what you're getting as a shareholder, we always suggest, number one, to look at total return, right? And make sure that ROC or income, like total return of the fund, is sufficient for your goals. And then also from a return of capital standpoint, when you're looking at that as a filer for your taxes, right? SVOL is kind of interesting in that the sub-account in which we are trading our futures has a fiscal year that is from June to June. And so the return of capital that gets reported on our website is effectively an estimate, which we have a disclaimer there for that. But that, labeling can actually come in, let's say, the next year's calendar year 1099. So it's a little funky. It's a kind of a strange way of reporting. But that's effectively why we report it that way.
Okay. Yeah, no, that makes sense. And, you kind of talked about the kind of that crash protection that you guys have. So we actually have a question from a user. Her name is Owlgood. She's kind of asking, can you kind of talk a little bit more about the call options protection, and then also a little bit more about maybe what the portfolio consists of? I know there's also treasury bills, as you mentioned. A lot of the funds that we cover on this channel, they're usually income ETFs, right, where they're just kind of holding, the NASDAQ index and then just selling covered calls. But this is obviously much different. So a little bit about the call options and then just the portfolio as well.
Sure thing. So short VIX products or short volatility products, we're kind of got a bad rep, right? When SVOL launched in 2021, it was coming fairly shortly after, the COVID crash in early 2020. There have been a number of products and strategies that have gotten into trouble when VIX has moved very far, very quickly, right? The most significant of which is called XIV, which is a product that effectively went to zero on a 100% VIX move back in 2018 during what's called Volmageddon, right? And so, the challenge with this exposure, and again, we kind of talked about how this is a feature in markets, right? You want to be selling vol, you want to be harvesting this market structure, slope, right? Most of the time, the problem is there's no free lunch, right? And so occasionally volatility can erupt effectively. And if you are exposed on the front of that curve, right, like when VIX goes to 80 or 86, right, like it did during COVID, the closer you are to that on the curve we looked at, right, and I'm just going to pop back over to VIX Central here for a sec, right, the closer you are to that front or spot VIX level, the more sensitive you are, meaning you are likely to see this curve invert where the front end comes up and then the back end raises, but, front is going to be elevated. And so if you are going to be short VIX, it is a prudent thing to buy the tail, right? And so buying deep out of the money options to say, look, I'm short vol. I know I'm going to have some correlation to equities, right? If equities correct or go into a bear market, I'm going to feel a little bit of downside just based on, having short vol, right? Being risk on. But if there is some type of catastrophic event where VIX goes nuts, I can very cheaply and effectively hedge that by buying out of the money call options. And so we'll typically buy, VIX calls that are, say, 100 to 200% out of the money. And, we'll spend, call it 3% a year on that. And our view is that, hey, if, we go through a year and we don't have a vol event, okay, we paid for some pretty, cheap but important insurance and we move on with our life, right? But in the off case that we do go through a major vol event, those options which we purchase for a very small amount of premium can be worth a very large amount. And so we're always 100% covered as far as making sure that the notional coverage on our option purchase covers the short VIX positions, right? And so that allows us to say, hey, look, again, we're not trying to hedge against a market correction or a minor vol event, but if something catastrophic happens, you're going to have this really nice tail or this what we refer to as convexity that helps those options carry or offset some of the losses in short VIX. Right? And then the goal for us as a strategist would be to say, hey, we know that those types of VIX levels or at those extreme levels, they don't last forever. And so the goal is then to say, let's try and sell some of those options while they're really, really expensive, right? And take that crisis alpha off the table and then walk away, hopefully as a happy camper.